Hi all, Bryan VantHof here with Remax Advantage Plus, Ramsey Trusted and the Minnesota real estate team. Hope you're doing well. Here we are, the last full week of October. Thanksgiving 4 weeks away, Christmas not that far behind, and 2026 also really not that far away here as we enter the home stretch of 2025. When we talk about real estate, we are really at the last great buying opportunity of the year for homes. It really starts right now. As we'll discuss, there are still a lot of great homes on the market, but inventory levels are going to start to decline fairly quickly, which we'll talk about the inventory levels and what that'll look like through November and December, at least from a historical standpoint. We're seeing a lot of similarities this year compared to where things were last year, at least for now. I think things will certainly change in 2026, but we'll talk a little bit about that here as we get into the discussion. But first, as always, let's start with the Twin Cities market for the week that was for previously owned homes, single family homes, townhomes, and condos within that 50-mile radius of downtown Minneapolis in Minnesota. We saw 918 new listings hit the market over the past 7 days. That is a drop of 65 over the prior week, but 93 more than this same week last year. 136 of those new listings have sold so far. Of our new listings, single-family homes were 648, which was down 9. 176 were townhomes, down 45, and 94 were condos, which was down 11. There are just 182 coming soon listings out there right now. That's down 53 from last week and actually 35 fewer than this time last year. Our total available inventory is 6,390. That is down 66 from last week, but 583 more than last year. For the total available inventory, 3,953 are single-family homes. That is down 53 from last week and 7.7% more than where we were last year. Median price of $450,000, down $10,000, and days on market of 48. 1 month ago, the median price on a single-family home was $475,000. So we are down $25,000 on median listing price from where we were just 30 days ago. So that's interesting to me. Of available inventory, 1,357 are townhomes. That's down 15, but we're up 17.5% from last year. Median price is $300,000. That's unchanged, and days on market of 43. That's up 2. Condo inventory is at 1,080. That's up 2 from last week and 10.2% higher than last year at a median price of $215,000, which is unchanged from last week, and days on the market of 90, which is also unchanged from last week. 655 homes went from active to pending. That's up 6. 621 went from pending to sold. That was down 24. And we have a total of 3,104 pending listings, which is up 14. Mortgage rates ticked up about 1/8% over the past week, with a good mortgage broker being between 6 1/8 and 6.375 on a fixed 30-year conventional mortgage right now. The Fed lowering their rates on Wednesday had really the opposite effect on mortgage rates with the tick up. Really, anytime the Fed governors or the Fed talks and they lower their interest rates, it actually ends up having a kind of a negative impact on overall mortgage rates, unless the Fed announces some economic distress that was unexpected. So the only time the Fed's announcements have a positive or a lowering of the mortgage rates if they say something that the market didn't expect in a negative way. So we're about the same as we were 30 days ago on rates, 1/4% lower than 3 months ago, 1/8% lower than 6 months ago, 0.5% lower than 9 months ago, and just under 1/4% lower than 1 year ago. We are 0.5% lower than 2 years ago, and really about the same as where we were 3 years ago. Showing activity was steady over the past week compared to the week prior at a very similar number of 11,950 compared to last week. Last year, we actually were busier than where we were this year. 12,360 showing requests at this time last year. So showings were down a little bit this year, even though mortgage rates are slightly lower. As noted over the past couple of weeks, we are right in the middle of what Realtor.com says is the best week of the year to be a buyer, October 26th to November 1st. Available previously owned single-family home inventory, or actually all inventory really, is likely to drop we will see a drop between now and the end of the year of anywhere from 30 to 40% of homes on the market. And that's just seasonal. That's just the way things are. Not because they're necessarily selling, but because some sellers are potentially taking their homes off the market, or there's not as many new homes coming to the market, and the ones that are out there are just getting absorbed up. But we will see a substantial drop in the number of available homes. Again, probably a 30 to 40% drop in overall availability, probably over the next 3 to 6 weeks as we get into December. December is, and we'll talk a little bit more about this, December is the slowest month for new listings to hit the market. So again, we'll talk about that. So let's dig a little bit deeper into the previously owned single family homes sales history over the past few years around the Twin Cities area. From 2015 through 2019, the peak month of new previously owned single family listings was May or June of each of those years, was generally where the most new listings hit the market. We averaged in those years, 2015 to 2019, about 6,400 new listings in either May or June. So that was a per month, not combined. That is a per month. May had 6,400 roughly, June had 6,400, depending on the year, but those 2 months were the highest number of new listings to hit the market. The lowest month of the year for new listings in those years was December, when there was an average of just 1,400 new listings that hit the market in December. This is just single family homes, not townhomes or condos. The number of new listings dropped nearly 80% from just 6-7 months before, between the peak and the low. November also tends to have lower new listings, right around, it's not as low as December though, but November also tends to be a very slow listing month. 2020 and 2021, they were their own unique, interesting characters. We had extremely low mortgage rates during that time, between 3 and 4%, almost completely driven by the virus that shall not be named. But the number of new listings in those years from the peak to the low were still lower than the previous 5 years. So even during 2020 and 2021, when mortgage rates were as low as they were, we saw less inventory hit the market. July 2020 saw a high in new listings of 5,300 and just under 1,800 in December. June of 2021 saw a high of just under 5,900 new listings to a low of just over 1,300 in December. Now, after that, COVID kind of over, or the virus that shall not be named, kind of over. But over the past 3 years, the past 3 May and Junes, which went back to tradition, those were the highest new listing months. May and June saw highs of around 4,300 new listings hit the market to a low of about 1,100 new listings hitting the market in December. So the past 3 years have been significantly lower than 2015 to 2019, and even lower than 2020 and 2021. And we're going to talk a little bit more about that. In our peak months, we have dropped 33% in volume of new listings to hit the market over the past 3 years compared to 2015 and to the end of 2019. So what about total single family homes for sale? Over the past 20 years, the highest we saw previously owned single family home inventory was August 2007, when there were over 23,000 homes available. By July of 2015, that number had dropped to just over 13,000 and dropped steadily until 2021. Since 2021, our peak months of previously owned single-family homes have hovered right around 5,200 homes. So 2007, 23,000 homes on the market. Right now, our peak of the year, 5,200 homes were on the market. We have seen available inventory of previously owned homes drop by 60% just from 2015. That is an incredible reduction in the supply of homes just in 10 years. Now we're going to talk a little bit about why that was. We're hearing prices are getting too high on single-family homes. Affordability is awful. Interest rates are too high. But why is that? There's been a lot of talk about affordability and how expensive homes are right now. I mean, affordability and pricing is all based on the fact that we have so few homes on the market, comparatively speaking, from a historical perspective. Good old supply and demand. That's what continues to push home prices upward. I had a friend ask me yesterday about BlackRock. Many maybe have heard the rumors that BlackRock is going around the country, buying up thousands and thousands of homes across the country to try to artificially drive up homes, make homes unaffordable, make it so people can never afford to buy, only rent. A lot of those rumors going around on the market, totally unfounded, at least especially in the Twin Cities area, and I really haven't heard anything about this legitimately on a national basis either. BlackRock is not the reason homes just seem to be expensive right now. They're not the reason inventory is so low, comparatively speaking. So why is inventory low, in which low inventory, high demand keeps moving prices upward? In my opinion, it's all tied to past and current interest rate environment. The incredible low mortgage rates we saw in 2020 and 2021, when mortgages were between 3 and 4%, caused the people who had purchased their homes between 2015 and 2020 to refinance into those much lower interest rates. Many of them now do not want to sell because they don't want to give up that mortgage rate. And that's the same with the people who bought in 20 or 21. They don't want to give up those mortgage rates. Our lack of inventory is completely driven by the fact that we had extraordinarily low mortgage rates in 2020 and 2021. The idea of selling a house when you have a mortgage rate that low, for most people, doesn't sound appealing when interest rates this past year and really the past 3 years up until now have been in the low sixes all the way up to the mid sevens. That does not sound appealing, to be doubling your interest rate. The idea of selling to buy something with those rates, it's just not appealing. The low historical mortgage rates in 2020 and 2021 probably actually had a very detrimental effect on housing, unfortunately. And we're feeling that today. Congratulations to you if you bought a house in those years or in time between 2015 and really 2021, and you refinanced to those low mortgage rates. You certainly were the beneficiary. And I know many of you were sitting out there going, if you won't have that, I'm not selling. Why would I? I've got this. I'm just not going to move. That 3 to 4% mortgage rate environment is probably long past us. You won't see that probably in your lifetime ever again. And that's probably for the best. Extremely low interest rates can have the same effect on the market as what people feel at high rates of 6 to 7% or higher. They don't want to sell because they have a low rate, and they don't want to buy because they don't want the higher rate. So what's the balance? I think we're getting closer to that. Mortgage rates in the 5s would go a long way toward freeing up inventory and getting us back to a healthy inventory level, or healthier inventory level. If that were to happen, which we kind of expect throughout 2026, prices will go up very consistently for several years. And why I say several years is because not everybody's going to sell their house next year. They're going to, houses, if rates are in the 5 or the 6, between 5 and 6%, not everybody's automatically going to go out and sell their home. They could, over the next 5 to 10 years, those houses will hit the market. But that's kind of what I mean by I expect home prices to continue upward. They are not going down, because we will see more transition, more sales in the market if interest rates are in that 5 to 6% price range. Mortgage rates in that 5% would allow enough incentive for sellers to consider a move from their 3 to 4% mortgage rate. And you could see a steady number of increasing sales over the 5 years that I mentioned as people make that transition into their next home, because it now makes more sense to them to do. Right now is the greatest time to be a buyer. In my opinion, you will never see home prices as low as they are, even though they're more expensive now than they were last year. They're more expensive now than they were 2 years ago. They're more expensive now than they were 5 years ago. But this is the lowest you will ever see, in my opinion, in your lifetime, is right now. Because next year it's going to be up 6 to 8%, and it will continue at a steady pace upward from there. Again, that's my opinion, but I see no reason to think that that's not going to happen, especially with rates in that 5 to 6% range. So that's what I have this week. Please forward this on to anybody you think could find this email video of value, to educate them on what's really going on. They may have questions about the market. What's going on in the market? When should I buy? When should I sell? What's the market going to look like next year? What's the market going to look like in 2 years? Forward this to them. I'm hoping this is helpful to them. I have so many of you that already do that, who open this email or forward this email 5 or 6 different times. A lot of multiple views on this email, so I appreciate that from all of you. So hope you have a great weekend. Please feel free to reach out at any time. I am here to be your real estate resource, your family's real estate resource, your neighbor's real estate resource, whoever you think could benefit. I know the market and can help you out. Hope you have a great weekend. Talk to you soon.